Good evening and welcome to a brand new show of Markets Tomorrow. A change in mood, not sure, but change in direction, surely yes, after 5 days of decline or above green for Indian markets today.
Well, we keep our fingers crossed that it is a change of direction. But anyway, let's just run you through who our three experts are over the next half hour on Markets Tomorrow. Manish Sonthalia, Senior VP and Head Equity Portfolio Management Services, joins in from Motilal Oswal. Sandeep Wagle, Founder and Managing Director at Aptar Technical Advisory Services. And there's also Nipun Mehta, Founder and CEO at Blue Ocean Capital Advisors. Nipun, wanted to start off with you. And, you know, just to take off from the point that Nikunj was flagging off, no doubt it's been a one-way trajectory for the markets. This move was just purely a flash in the pan. Do we really need to give it any merit?
Very little, really. I think a 12-point gain on the Nifty is really too small after 5 days of continuous fall. Technically, had it bounced, it should have bounced significantly, or that would have been an indication of probably a turnaround. But really, we are clearly in the middle of a range-bound market where a lot is being expected probably out of results, or a lot the street would be expecting to get direction more out of the results that are starting, the result season that is starting day after tomorrow on Friday. Once you have clearer indications on some of the initial results, which generally are positive, that is when really the market could take a direction either ways. It could be upwards or downwards. Really, after the September quarter results, there aren't very high expectations on positive surprises as far as the December quarter results are concerned. Typically, the third and fourth quarter results are good, but really, given the fact that the festive season hasn't been too good for a lot of the industries and probably a lot of the companies, and the interest cost continues to be high for a lot of them, probably you'll have very limited sectors which could have positively, which will positively surprise. So you could just have the IT where the currency has maintained at the current levels. You'll have one or two other sectors, but really limited positive surprises expected out of the results. So I think the market is reflecting that uncertainty, and till the initial results are out, you could just see this lackluster movement continuing.
Fair point. Sandeep Wagle, jump in with your technical take.
Nikunj, I think you summed it right. I think neither the bulls nor the bears seem to be confident. They don't seem to be interested. I think that is a better way to put it. At this level, the bears also seem to be tired. The market is not cracking down. It is drifting sideways, I would say, with probably some negative bias. As an investor, as a position trader with a few months time perspective, I don't think anything has really changed. I mean, we still remain bullish, though we may not be in a hurry to cross 6400, but talk of the next 6 to 12 months, we have been talking of the bigger targets. Let's not talk about that, but talk of the next few days, next few weeks. I think it is extremely stock specific. I mean, in a situation where the bank Nifty is not even moving 50 points, you have a syndicate bank, a Allahabad bank running away. So I have not seen anything like this, frequently before. So in that sense, extremely stock specific. Leave aside the Nifty, spot patterns and trade stocks, maybe mid caps, maybe small caps, which have strong patterns. I think they will work for you. Don't take a call on the overall markets.
Manish, let's get in your sense as to what one can really expect from the earnings season this time around, because do you think with what most of the analysts are saying that it's going to be a bit of a disappointment?
No, I think if you look at the earnings season this quarter, the base of last year was quite low. So in case of technology, even though everything seems to be priced in, you're looking at a 30% earnings growth. In the case of, let's say, healthcare, it would be another 18-20% growth. In the case of FMCG, it would be another 15% growth. In the case of autos, in spite of numbers not being there, and sequentially things might be just about what it was in the previous quarter, but on a YOY basis, things would look quite good. So, on an aggregate basis, we are looking at a 10 to 12% sort of an earnings growth. So, things are, and when you compare earnings, it's more on a YOY basis rather than a Q-on-Q basis. So, incrementally, things are looking okay. It's not a runaway rally. There will be hiccups along the way, but one needs to be more constructive rather than seeing the glass half empty. I would tend to think that the glass looks more half full.
Sandeep, we also did see that you had some of those mid-cap IT stocks which performed fairly well in the session. Do you like any, and do you think that all of the positives have already been priced in, or that there is more to go?
Well, I was liking Hexaware one, but then I wanted it to break 140, which it did not. So in that sense, I would wait and watch. Above 140, Hexaware begins a fresh move towards 147, 148, so could be a good trading play. As of now, I would bet with a HCL Tech, a TCS, and wait for declines and take a positional call rather than taking a 1 or 2 days call. So in that sense, I don't like any of the IT stocks in the IT space. And Infosys clearly looks a little weak. Now I would not want to act on it because we have the result on Friday, so probably that result blues is what is happening. But other than that, no clear view.
Sandeep Agle, what is your take on Tata Steel? It closed on 31st, when Tata Steel closed on 31st December, bulls were really chasing that stock. But Tata Steel has lost more than 8% this year. Do you think the short-term momentum for Tata Steel has reversed?
Nikunj, yes. When it broke the prior swing low of 406, 407, this happened I think 2 or 3 days back, the momentum has been reversed. But the trend is still intact. I mean, from a current level of 392, this stock can fall to somewhere around 375 or so. So if you're talking of a 5-6% trading downside, yes. But it doesn't look that weak where it will fall to 330, 340 where one can sell delivery and buy it back 7-10% lower. That is still not my view. At 375 around that, I would look at a buying opportunity for a target of 410, 415 as a position trade or as an investment.
Nipun, just wanted to get in your perspective as to what exactly you would be doing with banking stocks. IndusInd Bank puts out its numbers on Friday, and now you have some of the experts who believe, in fact, even Manish was saying this, that perhaps you might see a little bit of stress coming into the asset quality as well when it comes to the private names.
Strain as far as asset quality is concerned for private banks as well. I mean, it's not just that the PSU banks have been having strain. Yes, the private banks to some extent have been having strain. They probably handled it a little better. Some of the smaller names that are there probably have handled it a little better. The larger ones who had exposure to some of the power companies, to some of the Malia companies, probably suffered a little more. However, I think that provisioning is continuing, and what you're really seeing is the growth is enough as far as the private sector banking space is concerned, or the NIMs expansion or the top line growth expansion is enough to cover that incremental provisioning that's coming about. So clearly, I think the private sector banking space is likely to continue to see that growth momentum that we've seen. Probably provisioning is something which, depending from bank to bank, we've seen some of the larger private sector banks also suffering because of this, and that's something that will continue till this strain on some of these assets does continue, or till there is reversal as far as credit growth is concerned in a significant manner, really. I would still believe that despite all that strain that could be there, even as far as private sector banking sector space is concerned, there will be that NIM expansion that will be there, or the fact that the top line growth will pull the bottom line along with it, and will ensure that within the entire overall banking space, the private sector banking space will continue to outperform.
Manish, if I look at your current declared portfolio, you have a decent exposure to iShares, Page Industries, and Glaxo Consumer. So after the recent run-up, are you still happy to own these stocks?
Yeah, but earnings growth is coming, Nikunj. You know, the whole argument is that if earnings are going to double in the next 2 years for a Page or an iShares, it does make sense to hold on to these names. Because 2-year forward earnings, you are buying it quite reasonable. You know, it's about 20 times for a Page, and it's about 15 times for an iShares, which for a Page is a 60% ROE company. For an iShares, it is a good 25% plus ROE company. So you're looking at doubling of profits, and in case of Glaxo Consumer, you're looking at a healthy 20% profit growth for many years to come. I mean, just not for the next 2 years, but maybe for the next 5 years.
Sandeep, highlight for us, some of the individual stocks which really outshone in today's sessions. Also, you had the likes of a Future Retail which did fairly well for itself. Are you seeing more upside here?
Absolutely, Avan. In fact, I would say the weekly charts are showing me strength, and the move has just begun in that sense. So maybe not in F&O because the lot size is big and the move has already come in. But take a positional call at the current level of 91 down to probably 87, 88. I don't see the stock going below 85. And I would talk of a 101, 102 target over the next couple of weeks, which could probably even extend to 110, 112. So makes a case for a clear 20-25%, even probably a little higher than that, trading stroke positional upside.
We're getting you heads up from the dealing rooms, investment teams, as well as trading ideas that you can watch out for come tomorrow. Pranay is standing by from our research team first up with a word on what the dealing rooms are advising. Pranay.
Well, Cadila Healthcare and Usha Martin are the two stocks being recommended with the positive stance. So, Bank of America Merrill Lynch has come out with an upgrade rating on Cadila Healthcare and has raised the target price to 1,000 from the earlier 700, which implies an upside of nearly 18% from the current levels. And also it says that the stock which has continued to underperform the BSE Healthcare Index over the last 1 year now has the worst behind it, as the unit Hospira JV is clearly seeing its margins bottoming out. Also, the company as a consolidated entity is seeing a pickup in the drug approvals coming from US FDA. The launch pipeline is also looking very robust, and the domestic franchise has seen a good recovery in the third quarter, which will show in the results coming up forward, and therefore it believes that the earnings will accelerate at 30% year on year over the next two fiscals. So watch out for this one. Usha Martin is something which also ended today near the day's high and striking a new 52-week high at 35. So it has already seen very strong momentum over the last 3-4 sessions where buying has picked up, and analysts are indicating that the realizations over here will be higher because of its captive iron ore as well as coal assets, and the captive power is something which will help in the margin improvement of nearly 120 bips to 150 bips in the results that will be coming up. Also, its pellet plant is to be commissioned soon, so that will structurally enhance the margins, and the planned capex is over, so the debt cost will significantly reduce, and all this will add into the bottom line, and therefore dealers are recommending to buy Usha Martin with a target of about 45, which is an upside of nearly 25% from the current levels.
Pranay, thanks a lot for that. Sandeep Pagle, jump in with your top trading ideas for tomorrow.
Nikunja, buy in a syndicate bank, stop loss of 95, target of 108. A buy in a FRL, which we talked about, future retail, stop loss of 86, target of 102. And a sell in IOC, Indian Oil Corporation, stop loss of 199, target of 187.
Nipun, highlight some of the sectors that you'd be watching out for in terms of the earnings season that you think we'll see outperformance.
Well, I think clearly three sectors which have been often spoken about stand out. What needs to be very closely watched are the IT and the pharma sectors. Very clearly, these are sectors where you haven't seen any serious uncertainty as far as the overall space is concerned. There have been probably individual companies specific uncertainty that could have been there related to in pharma, FDA, or in relating to IT, maybe relating to the order flow that has been there. But overall, I think there's relative certainty as far as these two spaces are concerned. Besides this, I think the private sector banks, like I said earlier, should have limited uncertainty in terms of their NIMs and the overall profitability. I think a lot of the other spaces that are there are likely to have at least either of volume uncertainty or margin uncertainty or top line growth uncertainty that could be there. There will be individual spaces, individual stocks which will outperform within those spaces, but whether it is the metals or cement or the infra space or the real estate space, really there is expected to be a reasonable amount of uncertainty. So our pick is these three sectors which should be positive as far as overall results season is concerned.
Okay. Manish, closing comments from you. Pharma has been the story and pharma was the story today as well. As a house, what are you bullish on? As a fund manager, what are you buying into?
Yeah, this entire space is quite interesting, so a lot of mid-cap names are flying around here and there, and a lot of merger and acquisition deeds in the pipeline. Whole lot of names are there, but I think we continue to like an Ipca. I think they, we have it in our portfolio. I think the US business is going to gain traction from almost a zero turnover to a $100 million turnover in the next 5 years. This entire US setup, which was not there, is now kicking in for Ipca. The tender business is perfectly fine. It's doing perfectly fine, and domestic business, after a lackluster second half is gaining traction in the third quarter. So I understand that AIOCD data suggests that October, November have been quite good for the domestic market. So within the mid-cap space, we continue to like IPCA. I think within the CRAM space, DVS is a pick for us as far as the large cap is concerned.